Recessions made more millionaires than bull markets. The 1% know the pattern. Their exact 2026 version is finally public. Welcome back to Wealth Architect. I'm Dr. Ben. You've been told recessions are the end of the road. That's exactly what the system wants you to believe, so the prepared few can buy everything at fire sale prices. Today, I'm handing you the exact blueprint the wealthy have used for generations, updated for right now in 2026. We're breaking down the math that turns downturns into wealth explosions, the real moves the 1% made in past crashes, the fresh tactics that work in this cycle, and your simple 90-day starter plan that anyone can begin this week. Stick with me through every part, because by the end, you'll have a complete roadmap to come out of this recession stronger, with real cash flow engines working for you instead of against you. Let's get into it. Recession millionaire math. Let's start with the numbers nobody talks about on the evening news, because these numbers show exactly how ordinary people become extraordinarily wealthy when everyone else is panicking. When markets crash, asset prices don't just fall, they collapse to fractions of their true worth because panicked sellers flood the market at any price. The prepared buyer with cash in hand can buy the same income-producing property, business, or stock portfolio for 40 to 70% less than 12 months earlier. Let me walk you through the simple math so you see it clearly. Take a $500,000 apartment building that throws off $60,000 a year in net cash flow after all expenses. In normal times, your yield on that cash invested sits at 12%. But during the downturn, the same building drops to $250,000 because the owner needs liquidity fast. You buy it at that price, and your yield on cash invested jumps straight to 24%. That single move just doubled your money's productivity without any extra work from you. Now scale it. Do the same deal 10 times over the next 2 years, and you've built a machine that prints $600,000 a year in cash flow on a $2.5 million investment instead of the $5 million it would have cost before. Your return on capital just doubled again. This is not luck, it is arithmetic. Recessions force weak hands to sell at any price. Strong hands with liquidity simply step in and own the future cash flows at a massive discount. The 1% have run this exact equation in every single downturn for the last century and walked away owning the assets that power the next boom. Here's another way to look at it. Suppose you have $100,000 in cash right now. In a bull market, you might buy one rental property. In a recession, you can buy 3 or 4 of the exact same properties because prices are crushed. Each one still generates the same rent from tenants who still need a place to live. Your portfolio size triples for the same money. The math is relentless, and it works the same way whether you are buying real estate, businesses, or even publicly traded companies. One more calculation before we move on. Inflation-adjusted returns. During the 2008 crash, many commercial properties traded at 4 to 6 times their annual net operating income instead of the normal 10 to 12 times. That means you paid half as much for the same income stream. Over 10 years, that difference compounds into life-changing wealth. This is the foundation. Everything else builds on top of this math. 1% historical wins. Now, let's look at what actually happened in past cycles. Not the headlines, the actual bank statements and deal memos of the people who came out on top. Start with 2008. Warren Buffett deployed billions into Goldman Sachs and General Electric on terms that gave him massive preferred dividends plus warrants that later exploded in value. While the world screamed the sky is falling, he wrote checks and locked in 10% plus guaranteed yields with huge upside. Those deals alone added tens of billions to his empire. John Paulson turned a $1 billion fund into over $4 billion by correctly seeing the housing collapse and structuring the asymmetric bet through credit default swaps. He didn't invent anything new, he simply had cash ready and the courage to act when fear peaked. Go back to the Great Depression. Companies like Boeing and Chrysler were either born or completely rebuilt in the rubble. Boeing went from near bankruptcy in the early 1930s to dominating commercial aviation because they bought distressed aircraft factories and talent at pennies on the dollar. The founders who stayed calm and kept building came out owning entire industries for the next 50 years. Even in 2020, while small businesses were forced to close doors forever, the prepared players scooped up distressed commercial real estate, undervalued tech infrastructure, and entire niche service companies at fractions of their replacement cost. Airbnb, for example, raised emergency capital at a low valuation during the travel crash and used it to buy up inventory and market share that became worth 10 times more once travel returned. Look at J. Paul Getty in the 1930s. While others sold oil leases for survival, he bought them aggressively because he understood the long-term demand for energy would only grow. Those leases became the foundation of one of the largest fortunes in history. The pattern repeats every single time. The 1% sit on liquidity, wait for maximum fear, then buy the productive assets that generate cash flow for the next 20 to 30 years. They don't fight the cycle, they ride it and own the recovery. These are not fairy tales, these are documented outcomes you can verify in SEC filings and biographies. The same opportunities exist right now in 2026. Why this 2026 recession creates even bigger opportunities. This cycle has its own unique flavor, so the old playbook needs fresh updates. Interest rates have been higher for longer, corporate debt loads are elevated, and sectors like commercial office space, regional banking, and certain retail chains are already showing cracks. Supply chain shifts from tariffs and trade policy are pressuring small manufacturers. AI automation is disrupting service jobs while creating new ones in data centers and specialized tech. All of this creates forced sellers, exactly what the 1% look for. Local service businesses that people still need every day, auto repair shops, home maintenance companies, medical supply distributors, discount retail outlets are suddenly struggling with higher borrowing costs, even though customer demand remains steady. That gap between steady demand and temporary cash pressure is where the real money is made. Secondary cities away from the coasts are seeing population inflows while big city office towers sit empty. Industrial warehouses near ports and rail lines are becoming more valuable because reshoring is accelerating. Small manufacturing operations that can pivot quickly to domestic production are suddenly in play at discounts. The 1% aren't waiting for the news to declare the bottom. They're already positioning capital into these areas because they understand the cycle always turns and the assets bought at the bottom become the cash machines of the next decade.
Updated 2026 tactics. Here are the exact moves that work right now in this environment. Tactic 1. Liquidity in multiple forms. Keep cash, short-term treasuries, and pre-approved lines of credit ready to draw instantly. When a deal appears, you move in hours, not weeks. Tactic 2. Target distressed but essential cash flow businesses. Auto repair, plumbing and electrical services, discount grocery, home healthcare supplies. These never disappear. Owners facing high interest on loans become motivated sellers. Tactic 3. Asymmetric bets with limited downside. Undervalued industrial assets, specialized real estate in growing secondary cities, or small manufacturing operations that can pivot. The key is buying at a price where even if recovery takes longer than expected, you still cash flow positively. Tactic 4. Build your own economic moat immediately after purchase. Secure long-term leases with tenants, lock in exclusive supplier contracts, or develop unique skill sets inside the business that competitors cannot copy overnight. Tactic 5. Partner instead of going solo when capital is tight. Find owners who need liquidity but want to stay involved. You bring cash and structure, they bring operations knowledge. You split the upside. Tactic 6. Focus on cash flow first, appreciation second. In 2026, the winners are buying assets that throw off money month after month, regardless of what the stock market does. Tactic 7. Use seller financing creatively. Many motivated sellers will carry paper at below market rates just to get the deal done quickly. That lowers your cash out of pocket and your monthly payments. Tactic 8. Stack government incentives. Reshoring grants, energy efficiency credits, and small business support programs are available now more than ever. Layer them on top of your purchase to boost returns. Tactic 9. Build your personal deal pipeline. Drive neighborhoods, talk to brokers weekly, attend local chamber meetings. The best deals never hit the open market. Tactic 10. Document and systematize everything from day one. The first deal teaches you the process. The second and third become easier and larger because you have a repeatable system. These are not theories. These are the exact plays the prepared are executing right now while most people are still frozen. Risk management and protection strategies. Before you make any move, you need to protect what you already have. First, run stress tests on every potential purchase. What if rents drop 20%? What if interest rates stay high another year? Build a buffer so you survive the worst case and still profit. Second, diversify across asset types and geographies. Don't put everything in one city or one industry. Third, keep personal expenses low and separate from business cash flow. Your lifestyle should run on a small percentage of what your assets produce. Fourth, have insurance and legal structures in place, LLCs, proper contracts, umbrella policies. One lawsuit can wipe out years of progress if you are not protected. Fifth, maintain relationships with lenders and attorneys who specialize in distressed deals. When everyone else is panicking, you want trusted professionals who can move fast. Your detailed 90-day starter plan. You do not need millions to start. You need clarity and the first small moves executed consistently. Here is the exact 90-day sequence broken down week by week so you know precisely what to do every single day. Days 1 to 7, Foundation Week. Audit every dollar coming in and going out. Write down every expense. Cut anything that is not essential. Target freeing up at least $500 to $1,000 a month immediately. Open a separate high-yield savings account labeled Opportunity Fund and move the first freed-up money into it. Research 3 local markets within driving distance that show signs of distress but stable population. Days 8 to 14, Intelligence Week. Drive through target neighborhoods. Note for sale signs on commercial properties and businesses. Take photos and notes on condition and location. Start a simple spreadsheet with columns for property or business name, asking price, estimated cash flow, and your calculated yield. Talk to at least 2 real estate agents or business brokers and ask what is moving quietly off market. Days 15 to 30, Deep Analysis Weeks. Pick your top 5 opportunities from the list. Run full numbers on each one using conservative assumptions. Calculate break-even points, cash-on-cash returns, and worst-case scenarios. Reach out to one owner whose business looks motivated and ask for a casual conversation about their situation. No offers yet, just information gathering. Read one book or listen to one long interview from someone who bought during a past downturn. Days 31 to 45, Network and Prepare Weeks. Attend one local business networking event or chamber meeting. Introduce yourself as someone looking for opportunities in cash flow businesses. Connect with at least 3 people who might know motivated sellers. Get pre-approved for any lines of credit or small business loans you qualify for, even if you don't use them yet. Build a 1-page summary of your background and goals that you can hand to potential partners. Days 46 to 60, First Offer Weeks. Make your first written offer on one of the opportunities, even if it's low. The goal is to start the conversation. Prepare a simple letter of intent that shows you are serious and have cash or financing ready. Follow up politely every few days. At the same time, continue adding new opportunities to your list so you always have options. Days 61 to 75, Negotiation and Due Diligence Weeks. If you get any interest, move into full due diligence. Review financials, inspect the property or business, talk to customers or tenants if possible. Bring in a trusted accountant or attorney for a second set of eyes. Negotiate hard on price and terms using the math you learned earlier. Show the seller exactly why your offer makes sense for both sides. Days 76 to 90, first close and system week. Aim to close your first deal or at least have a signed agreement by day 90. Once closed, immediately set up systems to track cash flow weekly. Document every step you took so you can repeat the process faster next time. Celebrate the win and immediately start looking for the second opportunity. Scaling beyond 90 days. Once the first deal is done, the process accelerates. Use the cash flow from the first asset to help fund the second. Reinvest every dollar of profit for the first 2 years. By month 12, most people who follow this plan have 2 to 4 assets working and the confidence to keep going. The elite think in decades, not quarters. Stay patient and consistent. Common mistakes and how to avoid them. Mistake 1, waiting for the perfect time. The bottom is only obvious in hindsight. Start small and keep moving. Mistake 2, using all your cash on one deal. Always keep reserves. Mistake 3, buying something you don't understand. Stick to industries you can learn quickly. Mistake 4, ignoring the numbers and buying on emotion. Run the math every single time. Mistake 5, going it completely alone. Build a small team of advisors, even if they're just mentors you check in with monthly.
Tools and resources you can use right now. Free spreadsheet templates for cash flow analysis are available online. Search for simple rental property calculators or small business valuation worksheets. Local libraries often have free access to business databases. Join 1 or 2 industry Facebook groups or forums for the sectors you are targeting. Set Google alerts for keywords like business for sale in your city, plus the word motivated. These small habits compound into a steady deal flow. You now have the complete framework. No fluff, no waiting for better times, just the proven pattern the wealthy have followed for generations, adjusted for exactly where we are in 2026, with every step spelled out so you can begin this week. Recessions are not the end of wealth building. They are the greatest transfer of wealth in history, and the 1% have been preparing for this moment for years. Now you have their exact pattern, the updated tactics, the detailed 90-day plan, the risk protections, and the scaling path to put it into action. If this blueprint hit home for you, drop your biggest takeaway in the comments below. Tell me exactly which tactic you are going to try first. I read every single comment and reply to as many as I can. Hit subscribe and turn on notifications so you never miss the next blueprint that arrives every single week. We're not here to manage money. We're here to design freedom. I'm Dr. Ben. I'll see you in the next episode. Let's go build.